If you could only use one technical indicator on your charts for the rest of your life, the moving average would be the choice of most professional traders. Why? Because its simplicity is its greatest strength. At its core, a moving average does one job brilliantly. It smooths out all the chaotic day-to-day price noise and shows you the clear, underlying trend. But here's where most beginners go wrong. They just slap a bunch of wiggly lines on their chart without a real strategy, hoping for a magic signal. They end up with analysis paralysis, watching lines cross and uncross until they miss the entire move. This video will change that. We're going to move beyond the basic definition and dive into a practical, actionable framework for using moving averages. You'll learn how to identify the trend's direction, its strength, and even potential reversal points, all by understanding the simple language of these powerful lines. First, let's clarify what a moving average actually is. It's not a predictive tool. It's a lagging indicator, meaning it tells you what has already happened. A simple moving average, or SMA, is the most straightforward type. It calculates the average closing price of a stock over a specific number of periods. For a 50-day SMA, the platform adds up the closing prices for the last 50 days and divides by 50. Each new day, it drops the oldest price and adds the newest, causing the line to move. This creates a smooth line that rides along your candlesticks. The other main type is the Exponential Moving Average, or EMA. The EMA is more complex mathematically because it gives more weight to recent prices. This makes the EMA more responsive to new price information. It reacts faster to price changes than the SMA does. The SMA gives you a cleaner, more stable view of the trend, while the EMA helps you get in on moves earlier. For a beginner, there's no right or wrong choice, but it's important to know the difference. Many traders use a combination of both. The single most powerful way to use a moving average is for trend identification, and the rule is incredibly simple. If the stock's price is trading above a key moving average, the trend is generally considered to be up. If the price is trading below the moving average, the trend is down. The longer the time frame of the moving average, the more significant the trend it represents. The 200-day moving average is the king, widely watched as the primary divider between a long-term bull and bear market. A stock trading above its rising 200-day moving average is in a healthy long-term uptrend. A stock trading below its falling 200-day moving average is in a confirmed long-term downtrend. The 50-day moving average is the workhorse for the intermediate trend. The relationship between these two is critical. When the 50-day MA is above the 200-day MA and both are rising, you have a powerfully bullish setup. This is the foundation of a strong trend. This leads us to the most famous signal in the moving average arsenal, the crossover. This is where one moving average crosses above or below another. The most significant is the golden cross. This occurs when the faster 50-day moving average crosses above the slower 200-day moving average. This is interpreted as a major bullish signal, indicating that the intermediate-term momentum has turned positive and is confirming the long-term trend. The opposite is the death cross, where the 50-day moving average crosses below the 200-day moving average, signaling that bearish momentum is taking control. While these are powerful long-term signals, they are lagging by the time a golden cross triggers. A significant portion of the uptrend may have already occurred. Therefore, you shouldn't use them as precise entry points, but rather as a strong confirmation of a major trend change. For more active entries, traders watch crossovers between faster averages, like the 20-day and 50-day EMA. One of the most practical uses for moving averages is as dynamic support and resistance. Unlike a static horizontal line you draw on a chart, a moving average is a level that moves over time. In a strong uptrend, the price will often pull back and find support precisely at a key moving average, like the 20-day or 50-day EMA, before bouncing and continuing higher. This pullback to support is one of the highest probability entry points for a trend following. Trader, you're buying the dip within a confirmed uptrend. Conversely, in a downtrend, moving averages act as dynamic resistance. The price will rally up to the moving average, hit a wall of sellers, and then resume its decline. This is why selling or shorting at the moving average resistance in a downtrend is a classic strategy. The beauty of this is that the market is telling you where it's likely to find buyers or sellers, and the moving average automatically updates that level for you every single day. Now for the critical mistake to avoid. Moving averages work beautifully in a trending market, but they fail spectacularly in a ranging or choppy market. When a stock is moving sideways with no clear direction, the price will whipsaw back and forth across the moving averages, generating false buy and sell signals that will slowly bleed your account dry. This is the kryptonite of the moving average. The solution is context. Never use moving averages in isolation. Always look at the bigger picture. Is the stock in a clear, established trend, or is it chopping around in a box? Combine your moving average signals with other tools we've discussed, like volume and support and resistance levels. A bounce off the 50-day moving average that is also accompanied by a huge spike in volume is a much stronger signal than a bounce on low volume. The moving average gives you the where, and volume gives you the why. Use them together to build a robust, multi-layered approach to the markets. Remember, this is educational content and not financial advice. All trading and investing involves risk, including the potential loss of principal. Please practice these concepts in a demo account and ensure you fully understand the risks before trading live. If this guide has helped you understand how to harness the power of moving averages, please show your support by liking this video and subscribing for more trading education. Now, I'm curious, what's your favorite moving average setup, and how do you use it in your trading? Let's discuss in the comments below.